The global economy is facing a number of challenges. We could say that storm clouds are rolling in. But it's not the case that these clouds are rolling in everywhere. There are parts of the world where there are still considerable amounts of strength. If you're a commodity or an energy exporter, you are buoyant with export receipts. And equally, much of Asia Pacific has been immune to much of this slowdown. Inflation is much lower, central banks aren't tightening to the same extent, growth is holding up pretty well. Even in parts of the world, such as Europe and the US, where we face these challenges, we are going into this period of downturn from a position of strength. Labour markets are incredibly tight, with decade lows of unemployment, rising wages, and firms still recruiting. Household balance sheets are in good shape, with saving levels relatively high and net debt relatively low. Business balance sheets are doing pretty well too, with corporate profits as a share of GDP close to record highs across many markets. And a number of the vulnerabilities that we often face going into recessions, such as asset price bubbles or risk of a credit crunch, they're just not there this time round, which reduces the risk of contagion or any sort of downturn or recession being propagated. The downturn that we're facing is likely to be relatively short and relatively shallow, with most forecasters expecting Europe to be pulling out of this recession by mid-year at the latest. Similar for the US, if not earlier. And if you look to Asia Pacific, well, they're not even suffering this particular slowdown. So growth will be staying pretty positive there.
Given the backdrop of high inflationary pressure set to continue well into 2023, volatility measures across the board will be elevated. That uncertainty is, of course, weighing on investor sentiment, and markets have to absorb these shocks. The biggest shock of all, rising rates. And this will cause more market participants to face capital constraints moving forward, and that's in part due to lagging valuation resets. Those factors will see more capital observing from the sidelines and will inevitably slow the pace of deployment. For institutional investors, allocations to real estate may remain intact, but the equity and bond route are certainly triggering denominator effect concerns. And that dynamic is reflected in a shift in fundraising activity, with closed-end funds decreasing for a fourth consecutive quarter. The caveat being Asia Pacific, where fundraising momentum remained resilient, contrary to the precipitous drop elsewhere. Another thing to note is, while we do see APAC investment volumes moderating, we have to put into context Asian currencies' depreciation against the US dollar strength. Another thing that we monitor is the moderation of bidding activity, largely a result of increasing costs of debt. We witness a weakening of the winning bid-to-ask gap across sectors with nuances. Looking ahead, rate changes will introduce additional price discovery to the markets, and those adjustments will pose risks to market efficiency in the near term.
Given the current macroeconomic conditions, one of the biggest concerns we have is the deceleration of industrial demand. Looking back, the increase in consumer spending and in online shopping together really boosted demand for the logistics sector. And looking in the future, we do think supply chain modernization, getting close to the end customer, and e-commerce all together are going to drive growth for the sector long term. Demand has diversified beyond the big e-commerce players that dominated the sector globally. Now you're starting to see a lot more activity with 3PLs, with traditional retailers, with logistics and distribution companies. In addition to that, one sector to mention is manufacturing. We're starting to see a lot more regionalization of manufacturing, specifically automotives, electric vehicles, battery production, all together combined are contributing to demand for industrial real estate. Gateway port markets will continue to show strength over the long term. This includes markets like Shanghai, Los Angeles, Singapore. In addition to that, another subsector where we've seen strong growth in recent years has been urban logistics, which is dense population markets and markets like London, New York, where a lot of people live, consume, and shop online. They'll continue to see a lot of growth as well.
Corporate leaders believe the office will remain central to the organization ecosystem, serving as a hub for fostering employee well-being and boosting individual and team performance. And this is a good thing. But today, 59% of workers see achieving a good quality of life as a priority before a comfortable salary. This proportion rises to 69% amongst hybrid workers and even more important to the most senior cohorts. So we have to pay attention to this. Employers must facilitate mobility at scale by considering a more dispersed footprint, giving access to a local third places network. And offices must become a destination where employees can experience a strong community feel, a sense of belonging, and find a common purpose. So the future does not fit in the containers of the past. We need to adapt and be more resilient. But balancing the need to provide flexible working arrangement, which is an imperative, against providing working environment meeting the complex needs of employees requires solutions aligned with the aspiration and priorities of a more and more volatile workforce. Leaders are faced with complexity, uncertainty, and paradox.
Across the developed world, our cities are dominated by old, underutilized, and energy inefficient buildings. These buildings now present a huge challenge for owners, occupiers, policymakers, and communities to make them future fit for a low carbon world. We need to prioritize retrofitting efforts and ensure existing buildings are sustainable and energy efficient. Retrofitting doesn't have to happen all at once. It's a complex process, and we must consider a wide range of actions relating to embodied and operational carbon, life cycle assessments, local energy grids, and offsetting. Both landlords and tenants stand to gain significant value by collaborating to form new partnerships, create new business models, and identify co-investment opportunities. Retrofitting is clearly the responsible course of action if we are to meet our global net zero targets. And net zero carbon interventions are both more viable and responsible when considered in tandem with broader asset repositioning.